On today's Hashi, I'm discussing housing inventory, Fannie Mae's housing price index, and an updated forecast from Mortgage Bankers Association. Today is Monday, October 16th, 2023. I am Byron Lazine, and the hot sheet starts now. Good morning to this Monday here in mid-October. I'm sitting in my Naples, Florida studio, and I'd love to know which market you're tuning in live from if you're here on the live chat. Let's get right into it. We've got an update on inventory, and it's not our typical update from inventory. The Housing Wire full piece seems to be lagging, but we do have a calculated risk breakdown of Altos research data week over week as well as year over year. So we'll take a look at this today as we do every single Monday. And then tomorrow we'll get the full update as we typically do every single week to kick off. So inventory is what we're tracking the most. It's what's impacting affordability more than anything, more than even those high interest rates. And for the week ending October 16th, today, inventory increased 1.8% week over week. It's down 3.5% year over year. So we're finally starting to close that gap. And maybe, just maybe here in quarter four, we can get into the positives for inventory on a year over year measurement. 1.8% week over week is not much, but it is something. Inventory was at 546,000 on a 7-day average compared to 537,000 the prior week on a 7-day average. Year to date, inventory is up 11.3% from January 1st. Of course, we expect that every year in January to be a low point for inventory. It's up 34.8% from the seasonal bottom 26 weeks ago. Okay, so we've at least recovered from that, which was an extreme low. Let's take a look at some of the graphs which we have available in our daily download for BAMX members. Every single hot sheet show, you have the 7-day average and the 90-day moving average. You can see here we are basically net with 2022, still relatively here the last couple of years in all-time low territory for inventory. Okay, and of course tomorrow, like I mentioned, we will get into all the typical charts that we do around inventory, but this one should suffice to paint the picture here until we get into tomorrow. 3.5% year over year from 2022 and 42.3% down from 2019. If anyone asks what's driving prices still despite the 8% or near 8% mortgage rates, it's precisely this, that we don't have the homes available even with less people who can afford them. The red line being 2023 this year, below 2022, but hopefully getting close to crossing over as we did earlier this year in the week 25-26 range. And then 2021 being the 1 year below the last 2 years, of course. 2020 took a nosedive at this time of year. We're hoping to see an increase this time around. 2015 to 2019 were normal real estate markets, certainly in comparison to anything we've seen the last 3+ years. Those that were in the business in real estate, whether from a sales perspective or another component of the industry, remember 2015 and 2019 as being quite normal. Steady increases on home values and really an even market in most areas for buyers and sellers. There was some really hot markets, of course, but overall across the country, you had more of an evening, more of a level playing field, something closer to 5 or 6 months of inventory in many markets during those years, making it much more normalized than we're experiencing today, albeit months of inventory are creeping up just a little bit, but still well below 4 months and well off of 6 months, which would be a completely even market. And that's an important number, I think, in any area for sellers to understand that, yes, you still have the advantage right now in terms of, is it a buyer's or a seller's market? Yeah, it's still a seller's market almost everywhere. That number's starting to creep up, getting closer to 4, and starting to come back, hopefully towards 6 months of inventory towards a level playing field. But you have a seller's advantage right now in a much smaller pond. Okay, it was a huge pond in 2021 when sellers had the clear advantage, and in early 2022, I mean, you had a Pacific Ocean of a pond to fish out of in terms of buyer demand. Now, with where interest rates are, you just have much less buyers, so you're dealing in a much smaller pond. It's like going from big market LA Lakers to small market Portland Trailblazers, if you want the NBA analogy. Okay. In 2022, inventory didn't peak until late October. So hopefully we're going to continue to see over the next couple of weeks inventory continue to rise, and we get our high point here in the future, because that'll help prices. It appears the same week inventory will be below 2022 levels for the remainder of the year, depending on when inventory finally peaks this year. We haven't seen it peak. Right now, we are at the highest point of inventory for 2023. We're all rooting for that to continue to go up. That will stabilize prices more than anything else has shown to do so yet this year. Fannie Mae responded to prices this week in their Fannie Mae HPI home price index, that is FNMHPI to be exact. They read a national repeat transaction home price index measuring the average quarterly price change for all single family properties in the U.S., excluding condos. So we're going single family here. Here's the quote from their chief economist, Doug Duncan. Slightly slowing home price growth may reflect in part the affordability impact of the higher rate environment, even though prices were still solidly higher this past quarter than a year earlier. We're now in the fourth quarter when home price appreciation typically slows. And with interest rates both higher and more volatile, it would be reasonable to expect some additional slowing in price appreciation. But the ongoing supply problems continue to drive the larger affordability challenge. This quote here is a conversation that many listing agents are going to be having with their sellers. We are now getting into a time of year when home price appreciation typically slows. So if you're looking at comps, which is 60, 90 days in the rear view mirror to set your home price, and you want to set it above the comps, you're leading into a time right now in quarter four when home price appreciation slows. So if home price appreciation is slowing and you're putting your home above the comps, you're moving further away from each other on where you want to price for quarter four and where the market historically goes and where it's showing us it's going today. That could be a mistake for many home sellers, especially if you're in a market where inventory is higher than the national average, where you have more competition from sellers on the national average. Obviously, a lot of this is going to be localized, and there's going to be some areas like in the Northeast where the inventory is going to dictate that you probably could push price because you don't have any competition, albeit for fewer buyers. Okay, but you're going to see this right now. Sellers to the party are going to try to jump up and set a record. Setting a record in November and December is really hard. You don't see many records in November and December for many markets across America, because this is when, as Doug Duncan points out, home price appreciation typically will slow. Okay, and you'll start to see that go forward here in the next couple of months. And it's really more of the supply, the inventory, that is keeping prices even where they are today because of the interest rates. Obviously, people would have thought they would already be down. Here is a chart from Fannie Mae's HPI. I think is pretty interesting because it shows you the year over year percent change matched up against their annual HPI. And you can see the volatility in the year over year percent change. Home prices grew 5.3% year over year in the third quarter. Okay, after coming down there on the year over year declines previous to that. So interesting chart there to kind of showcase the volatility from a quarter to quarter perspective or year over year perspective. But on the long run, you can see what real estate does. It just continues to move in the upward direction. This is a good long-term view for people who are thinking what's the future going to be on home prices. Well, in any given year, in any given quarter, any small snapshot of time, there can be some of these ups and downs, that dark blue line, that year over year percentage. But when you look on the long term from 1975 till today, you basically can draw a straight picture up and to the right on home price growth. Okay, so if somebody that's a first-time home buyer, that's a chart that might help them understand that, yeah, in the short term, in 2 or 3 years, there's going to be home price volatility. Good thing if you're a first-time home buyer and you're using that for your shelter for your home, you're not a flipper. You're not worried about what's going to happen in 6 months to 24 to 36 months. If you're buying on a 7 to 12-year window, you should be fine. By the way, get the most out of all of our content here at BAM by using code HOT down below to get into BAMX. That'll get you 10% off the annual on BAMX. And you'll get access to all of our daily downloads like the one I just showed you here each and every single day on the hot sheet, as well as all of our courses and our live community. Mortgage Banker Association has a new forecast out. Mortgage originations to increase 19% to 1.95 trillion in 2024. This could be good news that MBA announced at its 2023 annual convention and expo, and that they think there's going to be more mortgage origination in 2024. Does that mean there's going to be more buyers? It's up from the 1.64 trillion expected in 2023. Purchase originations are forecast to increase 11% to 1.47 trillion next year. By loan count, total mortgage origination volume is also expected to increase by 19% to 5.2 million loans in 2024 from 4.4 million loans expected in 2023. This is great news. It means that they're saying the consumer is going to get comfortable with this higher for longer interest rate situation, and that they're going to write more loans. It's good for the mortgage industry. It's good for the fluidity of the housing market. Now, here's some of their other predictions from Mortgage Banker Association. Both fiscal and monetary policies have contributed to the much higher level of mortgage rates. The Fed's hiking cycle is likely nearing end, but while Fed officials have indicated that additional rate hikes might not be needed, rate cuts may not come as soon or proceed as rapidly as previously expected. Lower rates should help boost both homebuyer demand and increase the inventory of existing homes, thereby supporting purchase origination volume in 2024. So they think at some point in 24, these rates will go lower. Okay, interesting. Job market will likely slow as we enter 2024. Fewer jobs added and unemployment rate increasing from its current rate of 3.8. They're projecting to 5% on unemployment in early 2024, or by the end of 24, that is. Inflation will gradually decline towards the Fed's 2% target by the middle of not till 2025. They're also, Mortgage Banker Association is projecting that we will see a recession in early 2024. So these are their updated projections. Now, remember, keep in mind, Mortgage Banker Association updates their projections every single 30 days, and they've been wrong in the past. They were wrong about this fourth quarter when they said we were going to be in the fives, the high fives for the 30-year fix. We're well off of that. We're nowhere, in fact, even close to it. Here's their new update for 30-year fixed rate interest rates going into the end of the year. So they've got us at 7.2% now here for the fourth quarter of this year. There's the 7.2 projection for fourth quarter. That's an easy projection to make just based on where things are at. But they have us lower in 2024. They have us at 6.8, 6.6 for quarter two, 6.3 for quarter four, and 6.1 to end the year on the 30-year fixed. In 2025, they have us in a 5-handle situation between 5.9 and 5.5 for the entirety of the year. Now, we've seen this timeline continue to get pushed back from Mortgage Banker Association. In fact, this 5.9 of Q1 2025 was actually in Q1 of 2024. So we've seen it the full percent pushback on the full year. They're saying 2024 will end again at 6.1. 2025 will end at 5.5. 2026, they say, will end at 5.4. This is a great chart. Now, listen, their projections have been lower going forward, and we know that it's been higher. But even when they project out to the long term, to 2026, it shows 5.4. So for any buyer, you know how sometimes you're working with a buyer, they're getting advice from friends and family. Hey, I've got a 3% rate. Why don't you wait till you get a 3% rate on your 30-year fixed? Show them this. Hey, Mortgage Banker Association doesn't even project 4s in the next 3 years. They're saying in 2026, we'll be at 5.4%. And listen, the market's been higher than their projections. So you could argue, based on the last couple of years, that Mortgage Banker Association is on the low side and that it might be closer to 6. Okay, 3% was an anomaly on 30-year fixed mortgage rates. Those don't come around too often. And if you're waiting to time that market, you're going to be waiting for a really long time. A lot of folks waited for decades to get to 3% 30-year fixed mortgage rates. How much home price appreciation are you willing to give up over the next coming decades before potentially we see it again? Now, nobody knows what the market is going to do. And I wouldn't advise any real estate professional to say that you do know for sure when the 30-year fixed rate is going to go lower. But we know what history has told us and what it has shown us. And every time we break 4.5 on the 30-year, on the 10-year treasury, that is, we do stay higher for longer. We stay in an elevated rate and we go nowhere near 3% on the 30-year fixed. That's what history has told us. And right now we're living in that world. Today, we start the week a little bit higher than we ended last week at 4.706 on the 10-year treasury. Of course, the 10-year treasury and the 30-year fixed are tied very closely together. Last week, we ended the 30-year fixed at 7.66, and the Freddie Mac 30-year fixed weekly survey was at 7.57. That's a high for the weekly survey going all the way back to the year 2000. Okay, so I know buyers get a lot of advice from a lot of different people. It's your job to show them what has happened in the past and what data we have to showcase the future. Waiting for 3% 30-year fixed mortgage rates is not a good plan. And if that were even to happen, just think about how many multiple offers you'd be up against as a buyer, as opposed to today when that is starting to lessen. Okay, as we start the week, Dow's up, S&P's up, Nasdaq's up, all up a decent amount here to start the week. So Dow's climbed 200 points. It's a busy earnings week in investor world. You have the 10-year treasury again going up. So we'll monitor that as we always do every single week. We'll have the full Altos research report for inventory tomorrow, and we'll go through that and see what that has to offer. Until then, have a great Monday and toodaloo.